Hi guys, this is Dan from the Investment ABC, your guide to financial freedom. And in this video, I want to talk about the current crash in growth and tech stocks and how it might play out ultimately this year. 2022 started the same way as 2021 ended, and that was bloody red. The Nasdaq Composite declined from its high in November of around 16,200 to currently 14,150 points. This is a roughly 12.5% decline from the peak. What is the reason for the tech decline? The main reason for the decline in tech and growth stocks is that inflation was picking up considerably and that the Fed is forced to tighten liquidity faster and more aggressively than most people have expected. The market was just figuring out very early that inflation won't be transitory. Therefore, hyper-growth stocks have peaked in February 2021 and started their decline. I was warning back in September that chances are high that inflation won't be transitory and that the Fed will be forced to act and that the markets are flashing danger signs, although there wasn't any sign in the charts at that time. The question now is if the markets have already priced in the coming rate hikes or not. How many rate hikes did the market price in already? In my opinion, the markets have been broken for some time now. The only reason why the markets have been running to crazy levels was the ultra cheap money the Fed has injected into the markets. This was a sign for investors to get into the markets for as long as the Fed is injecting more and more money into the system. Now, this cheap money is coming abruptly to an end, or this is what the markets are afraid about. The same way investors were piling all at the same time into the stock market, no matter the valuation, the same way they are throwing everything overboard right now. If we have a look at the chart of the Nasdaq Composite, we can see that we broke down out of a rising wedge pattern and also below critical support at around 14,200. If we can't get quickly above 14,200, the next target would be around 12,600 in my opinion. The market currently is begging the Fed to step in again to help out. It is screaming and yelling, but will the Fed do so? In my opinion, the Fed won't help the markets until another black swan event or once they have realized that the economy is in a recession. Until then, the markets have to find a bottom without the help of the Fed. Here is my forecast on how 2022 will most likely play out. We have already suffered a large decline in most tech and growth stocks. Many of these tech companies has lost 50% or more since their peak. So the selling pressure might get exhausted very soon. My price target for a short to medium term reversal for the Nasdaq Composite is between 12,500 points to 13,000 points. At that point, many participants will figure out that we are very oversold and there might be a chance that the Fed won't be as aggressive as they claim and that inflation is slowing down for some reason, or that a lot of the rate hikes are already priced in. We will see most likely sentiment shift and the institutional money on the sideline might jump back in. Furthermore, the sentiment is extremely negative and even the buy the dip YouTubers are now talking about a coming recession. This negative sentiment plus the peak in new Omicron cases will most likely lead to a bigger bounce soon. Omicron is far less deadly than the other prior strains, and in my opinion, it will be also the last strain and treated as something we have to live with in the next few months. So soon we will see positive headlines popping up left and right saying that we did it is over, and the economy can boom now. This might lead to a short to medium term increase in stock prices before the market figures out that a full opening of the economy plus supply side problems due to China's relentless lockdowns are increasing the inflation numbers even further. This will put pressure on President Biden, who will demand the Fed should bring inflation under control. Unfortunately, the Fed will listen and tighten even though the inflation is mostly due to supply problems. Ultimately, this tightening cycle will lead to a recession by the end of 2022 or early 2023 in my opinion, and inflation will transform into short-term deflation. A lot of wealth and cheap money already disappeared from the accounts of the average Joe. combined with higher interest rates and rising costs, will ultimately lead to a recession soon. The problem the Fed will have is to stimulate the economy again during that recession, since interest rates are at rock bottom, and I doubt the Fed can increase them too much this year before reversing again. Even if they do reverse course, they will need to inject even more money into the system than ever before, which will result in a loss of confidence in the Fed and the current monetary system. This will be, in my opinion, the start and trigger for the coming hyperinflation. I don't see another way how this ultimately will play out. I'm expecting some type of war, hot war or cybersecurity war, to divert the attention of the public and blame the collapse on someone or something else at some point in the future. So, should you buy the dip now? It all depends on your investment horizon. If you want to buy the dip for a trade, I would say that soon might be a good time to do so. I'm looking to enter once the Nasdaq Composite is hitting the 12,500 to 13,000 range. But this will be for a short-term trade. I am still holding some of my long-term speculative core positions like TED, Humacyte or Accelera for asymmetrical gains in case these companies succeed in what they are planning to do in the long term. One can't be out of the market completely, but holding cash will be king during this last short deflationary period, in my opinion. Unfortunately, most investors in this market haven't experienced the real bear market. They have recently entered the market and saw that the stock market will always go up in the long run when you just buy the dip. But what they haven't seen is that during a bear market, the money flow is different or changes. Every rally will be used to sell positions, so the dip keeps dipping further and further until most average people are maxed out. Don't forget that retail investors don't have a high income and aren't disciplined enough to dollar cost average. Once they're maxed out and they have taken their last savings to put into AMC stock and they see prices go down and down and down, they will lose interest in the markets and either sell and vanish or keep their stocks and never open the portfolio again. Bear markets are breaking most people's psychology, and bear markets tend only to end once the majority of investors have lost fortunes and are gone. The bear markets are cleaning all the excess that were built during the crazy times. Sometimes it will take forever for the price to reach certain past levels when the price of the stock wasn't supported by the fundamentals. So buying blindly the dip without knowing the fundamentals of your company will most likely lead to more pain. In my opinion, the era for crazy gains in the stock market will vanish for quite some time, and the world will enter an era with different problems. Real tangible goods will be where the money is flowing into. That is the reason why investors like Bill Gates have bought so much farmland. We will enter a period where our current economic system will look completely different. I'm not saying that don't buy the dip at all, but I want you to see the full picture. Only because something has worked in the past, it doesn't mean that it will work in the future if circumstances changes. If you like this video, hit the like button to support the channel and subscribe for future updates. Bye guys, and see you in the next one.